Welcome to California in Focus. I'm Cole Lauterbach, managing editor of the Center Square Newswire service. This week we'll be discussing California saying they've got no capacity for new spending, and that comes in the face of an overspent budget of $20 billion or more starting in 2026 in the face of weak sales tax revenue as well. Joining me is California reporter Kenneth Schrupp. Kenneth, what is the state saying the biggest reasons are for such a deficit?
Hey, Cole. Well, even though there's been some weakness in revenue that's not from high earners being taxed, the real problem is state spending is just growing too quickly, especially Medi-Cal, the state's taxpayer-funded healthcare system that enrolls about a third of the people in California and has spending growth of 8.6% a year through 2028, 2029.
And now that I mean, you talk about a percentage, but being such a huge state, that is a massive, massive amount of money by anyone's standards. Even at a federal level, that would raise eyebrows if this was being heard in a committee in Washington, D.C. How much is it?
Right. So we're going to see the state's general fund's obligations to Medicare go from the $30 billion range to about the $45 billion range in the next few years alone. We have a lot of cost pressures coming in online. One, we did expand Medi-Cal coverage to all undocumented immigrants, which is going to cost at least $5 billion. Those were estimates based on old immigration figures. New figures could mean this could end up costing a lot more money. We've also had a huge surge in seniors joining Medi-Cal because we eliminated asset limits for the elderly to enroll. This means somebody who lives in a very valuable house but is very low income will be able to just get, no additional cost healthcare from the government.
House rich but cash poor, essentially, you're saying, which is a very common thing in California.
It is very common in California. We can, of course, get into that in another podcast at some point, Proposition 13, and its effect on the elderly. But
now what are Republicans and others saying on the outside looking in? Because this is an LAO report. This is this is a nonpartisan state office saying this. This isn't necessarily, people on the outside looking in making any type of interested quip about the state's financial position. These are the state's own bean counters, right?
Yeah, that's true. The LAO is a nonpartisan state-funded office that is there to provide answers for legislators so they can figure out what they're going to do with money and what impact certain policies might have. And to California's benefit, they have stayed out of a lot of the partisan judgments that have characterized a lot of California bureaucrats. This is truly an independent agency. Republicans in the state are focusing on the state's budget growth rapidly having grown by over 63% in the last few years, including a $135 billion railroad program for connecting LA to San Francisco that might not finish before the state is bankrupt, which means that money is just going to have been wasted. This also could result in huge losses from the federal government under the Trump administration if it decides to withhold funding for California serving as a sanctuary state that will not deport undocumented immigrants, even those who are convicted of crimes.
Now, while Democrats, which run the state, control almost every lever of government, are saying that this is a shortfall, you've documented in previous stories that a lot of pay growth are above average. And the state, as you said, has never seen this much income in their coffers, with the exception of a couple of years during COVID, where they were experiencing, an influx, like a sugar rush of federal dollars as well. Do we see this as a situation where they're just looking to maintain that spending level that was boosted by federal dollars, and even though that money is long dried up?
Right. There's a lot of federal COVID spending that was used to boost state programs that the legislature then made permanent. This is obviously not sustainable. The state's revenues overall are higher than expected, which is why even with significantly higher than expected costs for government programs this year, we're only coming in at about a $2 billion expected deficit. So we'll need to somehow cut spending by about $2 billion. However, it's in the coming years, so the immediate next year after, we're expected to have about a $20 billion deficit. And over the next few years, it's going to keep growing and growing until it's about a $30 billion deficit. Current levels of spending are not sustainable. And we only are able to reach that $2 billion amount by taking money out of the state's rainy day fund. And that money is going to run out eventually. In fact, after next year, I don't think we're really going to have much more left.
You mentioned the one-time spending on recurring expenses, and we're seeing that in a couple different places. You touched on this before, but I think it's worth elaborating on how much California's budget relies on incredibly volatile income. Their tax, even their income tax rate, is one of the most progressive in the country, with a top rate of 13%, but it's only towards high earners, which you have a lot of, but it's not a consistent source of income. These are people that are getting IPOs cashed in on and things of that like.
Right. And by high earners, we don't mean somebody who's a programmer or a lawyer or an investment banker. We're talking about somebody who is making multiple millions of dollars minimum from an IPO of a company. The LAO said that a recovery built on the stock market is especially precarious. Current stock prices relative to companies' past earnings are at levels rivaled only by the transitory booms of 1999 and 2021. The LAO's report also noted that a third of the S&P's growth this year has been from one stock, NVIDIA. This means that we're really left with a house of cards where the basis is just these extremely high valuations on the stock market that have been undergirded by very low interest rates that have had people looking for yield wherever they can get it. If we do see asset prices start to go down as capital tightens up, we could really be in for a rough ride in California. The LAO said that because of the uncertainty in the markets, or uncertainty in general, the revenue could be $30 billion lower or higher than what they expect each year. This would leave us with yet another major deficit. Last year, we did cut, shift, or defer $47 billion in spending to, quote unquote, balance the budget. In California, balance the budget doesn't really mean that. It really just means that we're able to make the minimum payments on our credit card debt so that the credit agency doesn't come and break our knuckles.
Yeah, I mean, the next bond issuance might be somewhere down in Compton off of Flag or something like that.
We have, if we look at other issues that California faces, we don't have money to spare. During COVID, we had an over $100 billion surplus one year, but we decided not to use that money to pay off our unemployment insurance debt to the government. During COVID, our government gave out about $32 billion in fraudulent unemployment insurance benefits in California. The California government in total owes, I believe, about $51 billion to the federal government for unemployment insurance borrowing it did during COVID.
And if anybody's paid taxes, no one breaks knuckles like the federal government when you owe them money. Kenneth, thanks for joining us today. Listeners can keep up with this story and more at thecentersquare.com.